Hi, good evening, everyone, to those who are in the broadcast currently. We from the IIM Kochi chapter alumni is presenting to you a short webinar session on investment during and after the current COVID situation. So we have two distinguished people from our own alumni with us to talk to you on various aspects about the investments, different type of investments as well, including equity and other options as well. And we are hoping this would be a good session for everyone, and you can post in your questions at any time you would be requiring. Just a brief about these activities which we are doing. This is part of the Kochi chapter alumni IIMK association. This is a good connecting initiative taken care by the Alumni Association, and we are also connected to the main campus activities as well. And this is creating a good synergy around all the community of people which we are engaging with. And currently, this is part of the finance series that is being held by the Kochi chapter. And there are quite a lot of interesting topics which are useful for everyone. And these sessions are conducted by the IIMK Alumni Association, the Kochi chapter. And going forward, let me introduce you to the team members and the panelists currently we have with us today. We have with us Arun Vijay. He is a treasurer by profession and a market analyst by passion, and a columnist and an active participant in the markets for the past 14 years. He started his career in the capital markets and later moved to corporate treasury, and he's a long-term value investor and a trader in smaller time frames. Welcome, Arun, to the session.
Thank you, Deepak.
Yeah.
Thank you,
we also have with us Geordie Pottas. He is a BBA LLB from the Symbiosis Law School, Pune. Holds a PGDM and EPGP from IIMK Kochi chapter. He is qualified to be a SEBI registered research analyst. However, he is not currently handling those activities, but he is a very full-time equity investor and a trader. The main activity which we know him is he handles a Twitter handle named AnAnthem in equity, which has more than 8,000 followers, which is one of the best places where you can look at how equity markets are behaving. Looking at his past, he started investing in the markets at the age of 19, and he is also a guest lecturer for finance subjects in the nearby MBA colleges. So I welcome you, Geordie, also to the session. Before starting, we have a disclaimer. All the views which are presented in this session are purely personal, and this should not be treated as any corporate view or where the panels are employed or associated. And this is purely for an educational purpose. All investments, buy or sell, is up to your own discretion. So with this, I invite Geordie to start your session, and he'll be briefing about the economy and how we are in the markets currently. Up to you, Geordie.
Thank you. Okay, I'm Geordie. With regard to in the current economy, it's very volatile in nature. So I'll be talking from the perspective of an equity investor, set of an equity retail investor. So for me, the price is what that matters. In the current market where there is huge uncertainty, we don't know where the world is going to be. But however, the stocks are not performing in that manner. The stocks are not showing too much of a weakness or something. We had a huge crash in March, but after that we recovered very fast. Now, what's causing all these things? So as a retail investor, I should be knowing about all these things. I should not be caught unaware in some stocks from which I won't be able to come out later. So the stock prices, the stocks and the businesses do not behave in an equal manner or at the same point of time. For example, if the economy is coming down, the stocks need not be coming down. If the economy is going up, the stocks need not be going up at the same time. Normally, we see that the stocks almost foresee what's going to happen in the economy by around 6 to 12 months. Now, in 2017, 18, we all thought, okay, the economy is going to do wonder, and because of that, there was some reason for the stocks to rally. And now in 2020, the rally is based upon the hopes that, okay, we are going to recover again. So the stock market always runs on the basis of hope. And what moves stock prices? It's all demand and supply. So as a retail investor, I should be knowing what the people are thinking. As a retail investor, I do not have too much power, to change the prices and such. I only play a very small part. So in that way, I'm a person who used to focus too much on the fundamentals, okay, and all those things, but the value part, but not anymore. Now I understand that it's the stock market is a place where it's an equation derived from the supply and demand. How people think, and that's what that matters ultimately. So that's my opening note. We'll continue with the discussions later.
Okay, thank you, Geordie. I'll take it to Arun. One more thing before that, all those who are listening, please post in any questions to be asked as well. So we'll post it directly to the panelists, and we could get an insightful session. Over to you, Arun.
Thank you, Deepak. When it comes to stock market, it's a saying is there that 2 plus 3 is 5. From Atlantic to Arctic and from Africa to Europe, everywhere is 2 plus 3 is 5. But unfortunately, in markets, it can be plus 8, can be 1, and even it can be 0. This is what my guru has taught me. But in month of April, we have seen that it can even go in minus also. We have seen that in crude oil, the crude oil prices has gone even in minus. So that's how market is. Every day is a new day. We will be learning something new. And we have to open our eyes and think in 360 degree, then only we can survive in this game. So coming back to this topic regarding the economy as well as the markets. Always markets are looking forward. My humble suggestion to everyone who really want to invest in market is that you should start thinking about the future. You should have a view about the future. You should be able to analyze what happened now, what is happening now, what is about to happen. If you know this is the basic of the game. And second thing is that we should understand the basic fact that markets are always right. As Geordie said, it's a simple game of supply and demand. If there is more demand, definitely the price will go up. If there is more supply, the price will come down. It's as simple as that. And again, back to the economy. Yes, we are seeing some green shots in some part of the economy, especially in the form of demand-based movements have been there in the economy. Demand recovery, we can say, in a pure economic language. So that has come in the form of purchases of some automobile sector purchases started coming up. Second thing, in e-commerce, yes, they were not able to deliver in many of the places during the lockdown. Yes, now they have started. So green shots are there also. And in two-wheeler space, people are scared to travel together, or they have to keep a distance while traveling also. So there is some kind of a movement has started coming in two-wheeler automobiles also. That's another place. And third one is regarding power generation. Yes, as the industry started rolling again, there is a power demand also has started moving up. But at the same time, there are some places of issue also, which we will discuss as and when, as in the same program itself. Yeah, back to you, Geordie.
Yeah. So, like I told, I always think from the perspective of that of an equity investor, of that of an retail equity investor. So, for me, how I see the economy is that, or I will be investing for the long term in only. Currently, I'm more of a, I think more in the short term. So people generally distinguish between an investor and a trader based on, okay, if somebody is holding their stocks for a long time, they are called an investor, and if somebody is holding their stocks for a short time, they are called a trader. I disagree there. Uh, I think if almost all the people are traders. It's just like the time frame changes. If I'm buying a stock at 100 if I'm expecting my stock to sell it at 1,000 rupees maybe 10 years later, then also I'm basically, it's a trade. I buy it at a low price, I sell it at a higher price. So it's only the time frame that matters. And based on that, for now, when I'm not able to see the future clearly, say for maybe after 6 months or 12 months, I don't know what that could happen. If all of my hopes, all of the market hope are based on some discovery of vaccine, and if it happens, yes, really good. But until then, I have to be quite nimble-footed. Until February this year, I used to have very long-term holdings. But by the end of February, from 100% equity holding, I suddenly sold off everything. I came to 100% cash by the end of February or by March beginning, because there were clear signals that were given by the market. And one has to have some real big common sense also. For me, I sold off everything at that point of time because I thought Corona had to play its play, had to have its play. The market was acting like it is ignoring those kind of things. But when the price action started to change, I always keep a stop loss in my investments. My tolerance level changes. So maybe during good times, maybe I will, or maybe on trending times, maybe I'll just trailing stop loss at maybe 5%, 6%. And during volatile times like this, maybe in those stocks which shows high volatility, there are some methods in technical indicators such as ATR, average to range. So based on those parameters, I adjust my stop loss so that I don't get stopped out from a stock which is about to jump further. In February end, suddenly all of those companies, it was basically nothing but I placed my stop losses perfectly, and when stocks started to fall by more than 5% or something, I thought there's something really wrong. And on the back of my mind, I knew that Corona had to have its place. So I thought, okay, I have made sufficiently enough in the last 1 year, so let me take a break and let's see where it's going. Without any emotions, I sold everything. So this sort of nimble footedness is really is very much needed. With regard to the economy, I think those companies which are market leaders with nil debt and good cash flow or with manageable fixed expenses, such kind of companies will emerge much stronger in the future. So that's what I think about the economy. We will have a bounce back, but everything depends upon a vaccine. So until then, it's a volatility play, and we have to position ourselves we have to keep the time frame of buy and sell we have to be ready to sell at any point of time. And it's good. And if my stop losses are not hit, fine, then I automatically becomes a long-term trader. So if my stop losses are not hit, next day I keep my stop losses a little bit higher. And so whenever the market in itself is going to go in a particular long-term trend, then I will also be able to ride the trend. So that's how I place myself in these volatile times.
Yeah, thank you, Geordie. That was a good insight on how you used to trade in the last few months. Arun, is that the same way you do your trading as well, or do you have any different view of opinion in this?
Actually, I exited from the small and mid cap in 2017 May 3rd week, to be very precise. That was a time when everybody started criticizing me why you have started exiting out when the markets are going to have to boom again and again. Then I said that no, the actual valuations of the properly fair valuations is already done. Then after that, whatever you are getting, you may not be in the right position. You may even lose whatever you have gained. So it's better to book the profit in small and mid cap. Later, I switched on to large caps, especially into Reliance, and there was some time I had some kind of large stocks. TCS also was there. So that was a time when the market was going up and again without any specific reasons, and it was creating new and new records. There was a time even that even the economy was not doing well. Hope you all will be able to recollect that in the late
Yes.
Q3 and Q4 of 2019. The economy was in a very bad situation. Still, the stock market was creating new and new records. That itself is the biggest indication that yes, this is not a good sign, and this is not going to sustain a lot. So I have exited gradually from the market way before in 2019, even from the large caps and even from the mutual funds also. So what I had left over was a little bit of stocks in 2020 beginning, and that too exited out when the crash has started coming. But I was able to exit out with a handful of profits, definitely.
Okay, that was good. We all were bit moving around. Initially, we moved out from the small and medium cap game from the market. Are we thinking that these firms are not good enough to invest currently, or what position are we in today, in the month of June or July, to invest in SMEs? Do we have any feed of that? Question to you, Geordie.
So you're asking me,
whether we can invest in SMEs currently. Is it a good time to
right?
go
I
for it?
generally, I mean, I have never invested a serious sum in SME companies yet. That's basically because as a retail investor, I can get only limited information about this company. I think so, and it's tracked also by very few people. So because of that, I generally have kept away from SME companies. Having said that, I think now the China, now we are hearing the news that Chinese imports are being stuck in the ports, and that the ships are not ready to take DHL. They have said that they are not ready to take shipments from China to India, and so on and so on. So because of these things, there will be huge shortage of Chinese goods, and this can be a good theme if played well for SME companies. This is where the small and medium enterprises in our country can bat really well. But we are also weak in lots of things. We are unable to compete with them in terms of cost and such. So the picture is getting better, but it's not so good. That's what I think. And other fact about SME is that since there is very less free float, I mean, so if I am buying, or if people like 100 people like me are buying on a particular day, then these stocks will go to upper circuit. And if we are trying to sell it off, it will go to lower circuits, continuous lower circuits for many days. So I am an investor who prefers consistency over the lure of huge super mega baggers. I used to be quite attracted to that earlier, but time has taught me that when I look for consistent increase, consistent compounders, that's what actually gives me very good returns. I mean, more than 30-35% sort of CAGR returns. So, to tell an example, with regard, so if you are traveling by a bus from say Mumbai to Pune, it's a Volvo bus. We know that okay, it's going to reach there in 4 hours, and I know that, and I can, during that point of time, I can read, I can talk to the fellow passengers and such. I also heard, if I have also have the second option, that's like, for the first 20 minutes I get to ride in a Ferrari, and then for the next 30 minutes I get to ride in a cycle, then in a bullock cart, then then with a bike rider who is very rash, and finally I may get a helicopter to reach Mumbai, and that too before 4 hours probably, or I may never reach there. So I prefer the first journey. So that doesn't mean, so risk management. Uh, Risk management uh, is ultimate in being a retail investor, and because of that reason, I for investing purposes I tend to keep be away from SMB companies. So that's what.
Got it. Thanks, Jody. Got where you are coming to. One question to Arun. We have seen a big drop in the indices or the markets in the month of March. That was almost a 40% dip from the peak we had in Jan. Have we fully discounted the impact of COVID currently, or where are we heading towards, or are we expecting this fall from Jan to the bottom can be more than the 40% what we have already seen? What is your take on that? Are we seeing any more waves coming down for the crash?
Regarding that January, February, March session, especially March 23, 7511 was the low, and from that level, the market has turned back. So actually what happened is that market has discounted only the lockdown and the business freeze. And as I said in the beginning, market is always looking forward. What's going to be next? What is going to happen in the future? That's what matters the most. The next 2 quarters, especially from July, 1st of July till the 31st of December, it's going to be very crucial for many companies and the economy as well. So those who are able to sustain, or those who are able to overcome this 2 quarters, will be the pioneers or the leaders or the first ones to come out of this difficult stage. Like in any business, if it is a cash-rich business, or even if it is a debt-free, or at least if it is not leveraged in the sense, if it have, they don't having that kind of a loan exposure, then they can even sustain with normal type of business also. But those companies, those who are into a leveraged stage, of those who are into highly loan commitments they have, or if they are having higher level of debt, then definitely they are going to have a very difficult session in the next 2 quarters. Then, having said this, the business models are going to change very drastically with this. As you have already noticed that many of us are already working from home, so the business model has changed. So there are companies, those who can adapt to this present situation or the latest situation. So they will be the winners in this game. That's one thing. And if you check with the startups, many startups, those who have come with some big wow factors, are now really suffering in these days. So as of this moment, sustaining the business is the main key, rather than growth, or even rather than an exponential outperformance, I would say. Then, having said that, getting back to your question, whether the market's has correction is completely over, I don't think so. The present levels itself is driven only by one company, as we all know, regarding Reliance. They have a major share in the index, and that share is really driving. That's the really driving force behind the new recovery which is happening in the markets. The present level, the next resistance in Nifty seems to be at 10,550. A little more also, it can go higher, 10,800, or maximum 11,000. A flash can happen. From there, again, it has to come down. That is only for the time being. Again, the more and more corrections are waited in the future also. Then the main issue in this economy is regarding the NPAs of the banks. So many banks has been given NPA, has been uh, given loans to many companies, and out of, as I have already said, the companies which are able to adapt to this situation, or they are able to overcome this, will definitely will pay back their loans. But those who are not able to sustain, that will bring out that will become a NPA for the banks as well as for the finance companies also. So the moratorium is up to 31st of August as of now. So after that only we can come to know which are the companies who are able to pay back. So that's what I feel about the markets from here onwards.
Okay. Thank you, Arun. Having said this, Geordie, what would be your stock picking criteria currently? Means, how do you pick stocks during this COVID times?
Um, so I started. I used to ignore technical analysis for almost 13 years, 12, 13 years of, and then because I was fully focused on fundamentals. I mean, I was very, very deeply focused on fundamentals. But it was then, you know, that I understood that people generally look upon quality, the growth, the longevity, and such sort of things, and that's. But people generally, or maybe the learned people, so they generally ignore the main factor there, the derivative, all these things, price. So from December onwards, uh, I started learning technical analysis, and that's for the reason of to understand how people think in groups like supply demand. So how a large number of people think at a point of time, and that information is crucial, and that we get only from these kinds of technical analysis. So nowadays, from April, so by April, I was back in the market because again, that there were some small trends of there are some good green shoots of further growth in the equity market, in the stock prices there. So I was back into it. But during this period of time, what I saw was that there was huge volatility in almost all the stocks. And so because of that, I'm using some technical indicators like stochastics and ATR. So I use these indicators to understand the volatility of the market. So if a company, so recently BHEL, so BHEL was moving in a channel like this. Okay, so that means the stocks were going like this, and the pattern was very clear. It was going up, but there was huge volatility in between. So what I did was I drew these channels. Whenever it hits the lower part, or whenever the stochastics basically moves from 0 to 100. 0, people think that stock is not going anywhere, and that's where the thing changes. So until February, while I was thinking very long term, now I'm thinking, okay, maybe for a week or so. And based on this, I entered BHEL at around 26. I'm just talking about the recent trade that I did. So whenever it goes up touches the top, it comes down. So the thing was very simple. So whenever the stochastics come down below 20, or when it crosses up from 0 to 20 and plus, I buy it. Whenever it touches up to say 100 or 90, and whenever it starts to come down by more than 8, by less than 80, I sell it. So this strategy worked beautiful for me, and that's how. So I deal with these volatile times. I take advantage of those volatile times, of these volatile times in this way. But one has to be very, very careful while dealing with this. There will be even after all these things. I mean, now I'm interested with almost like Arun told. I am expecting a huge crash, maybe in the next month or next month. I'm expecting that if it doesn't happen. Okay, so because I'm expecting this major crash, I don't want to put myself I don't want to be invested with 100% of my liquid wealth. So I have limited myself to 50%, and the rest 50% is in bank. Now, what that I lose may be the opportunity loss. So because if the crash never happened, and I must admit that I don't know much about the market, but I should be ready. So if the crash doesn't happen, and if it goes straight like this, then maybe I will lose an opportunity to gain some very big sums. But on the other side, if the crash indeed happens, then I won't lose my capital. For me, opportunity loss is preferable to capital loss. So that's how I play this market. And um, we all have to admit that until a vaccine is found and people normally goes out to pubs, goes out to parks, go hand in hand. Until that point of time, until the surety of a vaccine has come, the market will behave in a volatile manner. And there are other things also which there are other reasons also which are stimulating the rally as of now, and that's because countries all across the world, especially US and Japan, so they are printing money like anything. They are printing money to astronomical levels, and because of that, there is huge. So because of that, this money is then buying. US government itself is buying bonds. Japan is buying stocks and such things all across the world to just keep their economy high and maybe artificially high. So this has to fall somewhere. If it doesn't fall, okay, then it's really good. So this sort of super high liquidity in the market is what that keeps the stock prices high. And because of this, okay, during this volatile times, other major part of my portfolio right now is gold. I have been in gold since last year, and that did good for me. I invested in sovereign gold bonds by RBI. So it's a very good instrument to invest in if one is interested in gold. And I expect during this volatile times, gold loves volatility. Whenever there is volatility or whenever there is uncertainty, the governments across the world tend to stock up on gold because other areas of assets may become less attractive to them. So because of that, governments buy gold, and that will increase the price of gold. There is another reason why the gold prices, as we see now, have been going up very high. One of the reasons is that so when the government is printing money, or say if it's dollar is liability in the balance sheet. Because and so it's in the balance sheet, dollar comes into the liability side, and to counter that, there has to be something on the asset side. And in the asset side, then we have so they keep gold and treasury bonds. That's how they balance. And the treasury things is almost absolutely worthless because they're taking up so much of it. And the other part is then gold. So gold, so it's basically the asset that is gold. So the gold should match with the liability part of the extra dollars that are being printed. So dollar increases, gold also has to increase. That's market principle. This can also explain to a very great level about why gold should rally even further. Maybe, I don't know. I hope maybe 2 or 3 times. I don't know. Maybe it won't. Maybe it won't go like that because by that time some other equations would have changed. Then I will accept. Okay, now this is saying gold is not going to go. But as of now, what that I think is gold is going to have a super rally. So I'm interested in gold also. This is how I'm playing the market. So I'm long in gold and I do this short-term trades in equity, which shows beautiful channels of volatile. I'm basically taking benefit out of volatility. That's how I play this.
Okay, thank you, Geordie. That was a good comparison you linked it with gold. Coming back to Arun, would like to check with you, how do you predict the flow of the market? You just now told it might not go beyond 11,000, or you would have felt that a crash is going to come. How do you normally do that? And how important is global cues in understanding how the market is going to behave in India? What's your take on that?
Okay, very good question. First of all, we have to tune ourselves and the markets, tune our brain with the economy and market. means what is going to happen. That I have said already. We should be we don't have to look back what happened in 1920 or 1956, but we should know what is happening now. With that, what events are happening, we should be able to analyze what is going to happen and what can be the impact. A small example: there are some people, those who just read some news or hear some news, and they will just go for a buy or a sell. But you should understand that gone are those days that the newspaper will be, Wall Street will be printed in states and will come to here in India. Then only the price change happens. So yes, there was a time that it happened. In very early, investors used to play like that. But now, during the digital information era, everybody is updated about everything. You will get the alerts in your mobile. So news-driven markets are not going to work anymore in the real scenario. So what happens is that you should be able to analyze the as of the present scenario what is happening. A small example I can take it down. So when an event happens like COVID, then subsequently there was a lockdown. So what will happen to lockdown? Everything will get freeze. The business will be completely closed. There will not be any manufacturing. The economy engines of the economy, industries, infrastructure, everything will be totally in a freeze state. So at that time, what will happen is that we should analyze what is going to. So there are so many sectors which got affected. So what are not going to be affected, or how which sectors will get benefited out of it? So if you analyze in the last few days, when the lockdown is going to happen, definitely people will rush to any shop to buy more and more stuff. Obviously, retailers will get more business. So obviously, FMCG will also have a higher number of sales. So this too has happened. So whatever the bigger things these people are saying is that in order to save yourself from COVID-19, you should have your hand sanitizer all the time. So chemical manufacturers were having good number of business. And another one sector which has really gained after a long period of slowdown is pharma industry. Yes. So all these four industries were able to perform well. So that's how we should be able to analyze. Now, sitting here at this point of time, I can very well say that you should not take any bank or any financial company stocks. Rather, you should go for something else, because there is a high risk of NPA, which is going to happen in the coming future, coming quarters. And that's one thing. The second thing is how you are able to predict the correction. Like, very good question. Instead, I would like to ask the other question. Suppose Maruti Suzuki share price was at 9,700 rupees in 2019. So my question is very simple to a newcomer to the or an investor, you can say, will you buy a share of Maruti Suzuki by paying 9,700 when it was available for even 800 rupees in 2008-9 period, and after that gradually it started increasing up, and it was something like a rocket. It was just uh, making new and new records. So will you buy it that level? No, will not. Majority 99% will say no. So that's the time to sell if you have a Maruti stock with you. Very simple as that. And second thing, whether second question what you have asked is whether the global clues are connected with India. Definitely yes. A small change in US interest rates from 0.25 bps can affect a foreign institutional investor investing in India. As you know, the volumes are driven by the foreign institutional investors. So if the interest rates changes, definitely the FIA manager, the fund manager, will have a second thought on how much have to be invested in emerging countries like China or India, and which sectors we should invest. All these kind of things will change. So that's one thing. Now, second thing, a less number of manufacturing output numbers every month China releases. So that number is very crucial, because that shows how much is the purchasing power of the people across the globe. So data from Japan also matters. Third, crude price, definitely yes, from the Middle East, that matters a lot. And the fourth thing, the unemployment in the biggest consumer nation called US, that also matters a lot. So that's how I analyze the market. That's how I take a call in the market.
Okay, thank you, Arun. We'll go a bit quick because there are lots of questions coming in. To you, Geordie, we are hearing about a potential India-China standoff or a kind of trade mismatch that could happen. In your thought, which sectors could be most impacted due to this particular impact?
Okay, now we will not be having. I think that we won't be going for a war anyway, because that's a loss for both of these positions. So I'm keeping that out of equation. Now the economic warfare that's going to happen. I think the sectors that will gain or sectors that will lose will be for many of our manufacturing operations. All these units, the constituents, they come from China. So I cannot think about it in sectoral impact also. I mean, pharma will have problems with chemicals. Lots of chemical industries will be having problems. Because the pharmaceutical industries will be having problems. So in that way, I think but the higher impact will be for the Chinese, obviously, because we don't have much to lose like that of the Chinese. Chinese are much higher than that. So I don't even think this China-India things will sustain for a long time. I don't think it's not even going to be a long-term theme, because China absolutely do not want that. So they want us. Without us, the Indian market they are dead. So I haven't thought about this in that sense. I mean,
because it's quite new, actually. Because it's a quite new thing, because we all are thinking about what sectors will be most impacted at the COVID times currently, and we are yet to recover from the shock of the COVID, and those things are still yet to be recovered. On a similar note, there are many questions coming in on what sectors would be the most affected during the COVID times as well. And there are people who have invested in the airline or tourism industries, and they're asking what should be done with regards to their stock. Do you have any take on that?
Yeah. So in airlines, I like Indigo, but it's not that I'm invested at the current price levels. But those companies with survivor balance sheets, those companies with huge reserves of cash and with manageable fixed expenses, they will survive. And those companies that are the market leaders. Now, if you look at aviation, Indigo is going to be a clear winner, unless with the hope that we are going to fly again, and we will fly again. And at that point of time, these companies will be having immense pricing power also, because some of these airlines may be wiped off. So Indigo, based on that, I love aviation, but I will. The thing is, since I'm price conscious also now, I will buy it only when I buy it for a long time, only when I'm seeing a clear trend. I don't know when, but that's what I think about aviation. Regarding hospitality, again, those companies there is a small company called Sinclair's Hotels. So such kind of I use a website called screener.in to do my fundamental analysis. And so the analysis has become so much simple because of this website called screener.in. So when I look into that, I like those companies like Sinclair's and maybe Taj and all those hotels will survive. So but there will be lots and lots of pain further. But when those prices come down to extremely low levels, and when they start to go maybe for at least 2 weeks or 4 weeks, we know that okay, now when those prices makes 1 month high and 3 month high, we know that okay, now this has got its gear. These prices, these stocks are going to do better in the future also. So that's how I approach that. I approach these stocks. So there are going to be huge winners in all these sectors, but only very few of them.
Okay, there was one question that came in the live comments. I'll go to the couple of questions from the live comments also. It's a question maybe Arun can answer. The question from Tilak is asking whether price or value should be the key criteria during the situation like this. You could give your thought on this.
Okay, a very good question. Again, value matters a lot. Value matters a lot because if the company has got a good moats, if the fundamentals are very good, if the future is very good, there is a good management, there is good cash flow, their business models are good, they are the pioneers in the game, they are business leaders, then definitely it's a very valued company. Then second, what we have to look is the price, which is the opportunity. Opportunity will not come all the time. If you see many of the stocks, those who are at 2019 or 2020 January peak, we are still at a discount. Discount side is still on, and more discounts are going to come. Definitely, that should be considered as an opportunity to grab those. Actually, this COVID is not an uh, problem or a trouble. In fact, it's an opportunity for the real value investor to invest in gem of a company or gems or even in uh, top best companies in the world. I would say. I believe I answered your question.
Okay, yeah, thank you. Question to you also, to Arun, to you. People are asking about what should be the good investment portfolio currently, whether we should stay invested in the debt in the current scenario, or is gold a good opportunity currently, or is it the best time to be staying in equity and put all your money in equity and then see how the market goes? What's your take on that?
Yeah. Uncertainty, whenever there
To
is
you, Arun.
uncertainty in the world, then definitely only one instrument price will go on. No doubt it will be the yellow metal, which is gold. So whenever there is uncertainty, you can always invest in gold. It will fetch the maximum returns. That's one thing. Second thing, even at this COVID situation, definitely you should have, in the normal situation itself, you should have 15% of your portfolio should have weightage in gold. Your investment of total investment, 15% should be in gold. And in this COVID situation, I would say at least you should have 30% or even more, because and not and you should invest wisely. Not that you should go to buy gold from the nearest jewelry. No, it's not like that. You can say you will be surprised to know that if you have 45 rupees, you can buy Nippon India Gold ETF Bees fund. If you have a little more money, yes, definitely you can buy a stock which is into this assured business of gold pledging, because they are buying gold as a guarantee and they are giving only 75 or 80% of the market value for loan. So that's a very assured business. And if little more if you have, yes, another very good company from Kerala is there. They are also doing the same kind of business. Yes, they are also pioneers in the game. You can do that. Now, if you're not interested in any of these things, you want a mutual fund manager to manage the show, you can go with the gold ETF. And the most favorite for me is, as Geordie said, it is sovereign gold bond. You will be surprised to hear the advantages. If a person invests 1 lakh rupees, every year he will get 2,500 rupees as interest. And it is paid once in every 6 months. So 1,250 in every 6 months for every 1 lakh rupee you invest. After 8 years, it's totally a capital gain tax free. You don't have to pay a single penny as tax. It's totally safe, secure. So I would say you should invest in gold. At least 30% of your total investment now it should be in gold. And again, back to this other forms like a fixed deposit, I won't suggest, because the FD rates has come down very drastically. And after this TDS and tax on interest earned, you will be landing at par with the inflation rate. So I won't suggest a fixed deposit. And equity, as I said before, this is the right time to grab better quality, good fundamental, very good pioneer market leader stocks at a very good, reasonable or fair price. Thank you.
Okay, thank you. On a similar note itself, there are many questions also on mutual funds and mutual fund SIPs. People are asking whether they should stick on to the SIPs which they are doing currently, or are they sustainable, or should they get out from that? What's your take on that?
Definitely, it's a systematic investment plan itself says that you should invest systematically. But yes, at the higher prices, you should avoid investing more. As I said, the best example is the Maruti case itself. At 9,700 rupees, will you buy one share of Maruti? No. Then you should not invest more money, or you should reduce at least your systematic investment monthly plan on a fund which invests in that kind of an overvalued stock, I would say. But as time passes by, as I have said in the beginning itself, the coming next 2 quarters are going to be very crucial. We are expecting a very good correction. At that time, definitely whatever the money you have, you can add more to your SIPs. It will definitely fetch you better returns. And one small number game I wish to share here. In Kerala, the biggest business is lottery business. Okay. And every person, there are so many addicts who spend 35 or 40 rupees a day. A day means every month they will be spending the same amount of money. So about 1,000 rupees a month. If this 1,000 rupees, if they are investing in SIP, the scene will be different in a long-term run. And sorry to say this, out of all the buyers, those who buy this lottery ticket in search of their better fortune, 3/4 will definitely land up in loss. They are not going to get even a single penny. And the numbers are really mouth-watering for any corporates, I would say. 9,276 crores is a total business in the lottery business in Kerala, and it brings 1,673 crore rupees as profit to the government. So from that itself, you can understand that this is not going to give any benefit to the commons. But instead of that, if you go with such a systematic, disciplined investment in stocks, it will definitely give you better returns. It will give you a much better fortune, or it can create a better wealth for you.
Okay. Thank you, Arun. So, another question from Tilak. Maybe Geordie can answer this. He's asking, when businesses are facing a lot of trouble during lockdown and a lot of unemployment, but if you look at the US markets, it's hitting an all-time high, or is almost, we have seen that it has almost recovered to similar values that it was in the pre-COVID times. What would be the rationale for that, or what's happening in the US?
Yeah. This I have mentioned earlier. That's basically because there is huge amount of capital, very low cost capital available in the market, and so this capital is roaming all around the world in search of some places to invest their money, and they find that okay, in emerging markets like India, they maybe they believe that Indian stocks give good long-term growth, then they will come here. As of now, they think that okay, the US of these companies like Google, all the FANG stocks, Google, Amazon, such kind of stocks have got huge moats. Nobody can touch them as of now. So because of that, the the capital, that money that is being printed by the Fed, by the equivalent of Reserve Bank of India in US. So when they print that much of money, so this is just simply going into stocks and bonds, and that's how the prices are being kept up. And so that's the reason for the US stocks to just keep on going up. And there is nothing wrong in that. That's my another point. From if I'm talking as an economist or maybe as somebody else, maybe I think that okay, maybe this is going to be a huge problem. But when I think from an equity investor perspective, when I think from a retail equity investor, those stocks which are, it's an anomaly, but that works perfect. Those stocks which are at 52-week high, they tend to go further higher. So 20% higher this year, 30% higher next year, 25% higher next year, and those stocks which show this pattern, they tend to be always in this pattern. So there, I have identified two sorts of stock. I mean, I try to identify the market based on that. There are two types of stocks. One are trending stocks, which means they will be going like in a line like this. The other one is mean reverting stocks. Mean reversion. Mean reversion means if all the stocks always comes down. So there is an average price, and they always goes in waves like this. So they go, they come down to the very bottom, then they bounce, and maybe there's an underlying trend like this, and here it will go like this. So why do I love those stocks? I mean, why do I love those stocks? I love only those stocks which are making 50-week highs for my long-term investment. And obviously, there is always this stop loss to let me out of any problem that happens. But otherwise, and that's because of the supply and demand equation that I told earlier. Uh, I mean, so I'm telling this based on the question of US sales, because those stocks like Google, Amazon, Tesla, all these stocks keeps on going higher. That doesn't make any logic for when we think in numbers. But the reason is that another reason for the stocks to go up is that you see when the stocks are going up, okay, going up because the demand is higher and supply is lesser. So again, when the stock is at 100, they buy 110, 120, 150, goes on like that. But if there is another stock which is at 100, then it comes down to 90. What that happens is that there are lots of persons who are selling it at the level of 100. Now it is going down to 90, 80, 70. And from there, if the stock has to cross the earlier 100, and if it has to go up higher, then it has to face resistance. What is resistance? When the stocks comes down from 100, 80, 90, 80, 70, and when it tries to reach back to 80, okay, what that happens is those people who have bought it at 80 rupees, they'll think, oh my God, thanks, because now my price has recovered, so let me sell it. So there is a supply of stocks there. So then the stocks tend to go down further because the supply is coming. Now, because of some other reason, if there is extra demand, then this will cross the resistance of 80, and then it grows up towards 90, and then from there there's another huge supply from that, because those people who bought it at 90 and now waited till 70, they are waiting back. They will be waiting to sell it at at break-even cost. So they will sell it at 90, and then it goes to 100. So for a stock which has come down like this, and for them to go up further and make 50 highs and much higher, it is very difficult. But in terms of a stock which is going like the Bajaj Finance, now it has crashed, but that is because it's the black swan event. But in those companies which are going in beautiful up patterns, there is no supply ever. There's only demand. So as long as the momentum is there, these stocks keeps on going up higher. And that could be another reason when we think about stock-specific reasons for those stocks in US also, and as well as in India. Everywhere has the story same. When the supply is not there and the demand is higher, stocks keeps on going up. When the price has come down by say 50, 60, 70%, and if somebody is going to bottom fish there, it's going to be a very tough journey, because there is going to be huge resistance at all point of time whenever the price to come up higher. There is supply at 50 rupees, there is supply at 55 rupees, 60 rupees. The stock has to cross all of that, and it needs very sound fundamental structural reasons for the stocks to then go up higher. And if we can take advantage of this, so if we can analyze these trending stocks versus mean reversion stocks, those stocks which goes up like this and then like this, then understanding that concept itself will help us make money in any market.
Thank you, Geordie. That was a good analysis. Coming back to Arun, there are a couple of people who had asked whether during the current times we should stay focused only on large companies, or say the Nifty 50 companies, and we shouldn't be actually looking at smaller ones. So should we actually keep invested only on in the large firms with ones with very low debt and things like that? What's your take on that?
Yeah, actually, my first priority is capital protection. As I have said before, this is an uncertain time. We will not be able to know or predict which company is going to be there in the long term run, or even in the medium term run. We never expected the S Bank will have such kind of a bad scene some 4 months before. So what we should concentrate in during this kind of a uncertain time is that we should invest only in solid fundamental stocks. So why Nifty 50 is that? Nifty 50 has only some good fundamental stocks which are market leaders, pioneers. They are having good business model. They have time tested. They are gone through so much of cycles in their entire time frame. So I would suggest it's always safe to play with the Nifty 50 fundamentally good solid stocks. That's one thing. Say for example, why debt is a big issue in this present days in this uncertain days. I can quote two examples. Just now, Reliance was able to spend or sell off their 24.7% stake in Geo, and thereby collect 1,50,000 crore or even more, and they have used it to clear the debts. Last year, Mr. Mukesh Ambani has said during the AGM that we will be debt free by 31st of March 2021. But see, they were able to achieve that target even months before that. That impact has come in the share price. That impact has definitely come in the share price, and the share price has started moving very drastically. In fact, that is the one who is driving the Nifty index itself. So that's how a debt-free company will be attracted by very good value investors or long-term investors or even the fundamentalists. So if you want to be in a safe mode, if you want to protect your capital, if you are not ready to take any risk, better you always go with Nifty 50 large cap companies which are solid, which are proven, which are market leaders, which are having good moats. That's my view.
Okay,
And
thank you, Arun. Yeah,
to
go ahead, Geordie.
yeah. So, like Arun told, Nifty 50, Nifty 50 and basically almost all these indices stocks are based on momentum. Because why there is always a reconfiguration of these stocks in Nifty 50 based on what? Based on the size of the what? Based on the size of these stocks, based on the market capitalization. So you can, and that's why 95% of these times people tend to underperform these indices. And that's because Nifty and such sort of indices are based on momentum, which we don't understand. So those stocks, like I told before, those stocks which are getting bigger will tend to get bigger. So it's like that Newton's law of action. So those stocks which keeps on going up will tend to go up because those stocks are in Nifty 50, and because of that, fund houses will again buy that. Those stocks again goes up, and then fund houses will go up. And that's how the investing world works. The indices, but then that's one of the reasons why we find it very tough to beat the indices level returns also for the mutual fund houses. Just want to add.
Yeah, one interesting question from the crowd as well as, and we had got it earlier also. It's with the Vedanta and the new announcement by Adani Power as well. People have invested in these companies, which was a Nifty 50 company previously, and currently they are moving in a manner to delist it, and the promoters are buying back the shares at a very low price than the average price, lower than their intrinsic value, lower than their book value. So people ask me, how do we trust the market, or what is your advice on people who have invested in these kind of shares with a long-term perspective? Geordie, your view on that?
Yeah. So it's very tough again. See, for a retail investors, and we all are retail investors, we don't have much option to look at other than the annual reports, the con calls, the investor presentations, and the price history, and the business as such. That's what we understand. And I think the market is a if you make the market our friend, and if you see, the market always, all this insider information, this insiders, those people who knows much more than us. So they would have already taken some action with regard to their buy and sell in these stocks. So so if a company is going to delist at a bad price for the retail investors, and that's because the management of the company is having that character. And if the management of the company is having that character, they would have done such sort of things in the previous future also. So we just again, all this quality, growth, value, all these factors will be we will be able to see that in the price history. I generally tend to so when I'm looking at some stocks, the volume changes, the number of people who buys and sells these stocks at any point of time, and if the volume of these, if the buyers or sellers in these stocks, the volume of them the volume of trades has been going up in the recent future, then that means something. If it has been drying up, then that means something. So there are many ways in which we can understand what's going to happen in a company beforehand, because these all are clues. The smart investors, smart minds, would have already started. So the smart investors already know that okay, company is going to be this, or this company is going to do some bad things, or this company is going to do some very good things in the future. So if you see the volume profile and if you see the price pattern, and if the price is having a clear history, like a trending, like a beautiful line, then that means that the market has never almost had any big problem with the management. And that's how we can understand that, okay, if the market hasn't found any bad history with these companies and the management, then I can trust as well. On top of that, one should never invest in less than 10 stocks. Last year, I used to have bunch of 50 to 100 stocks at any point of time. And why what I do is controlling risk, because I believe that risk takes care of my rewards. So when I'm investing in say 50 to 100 good to great companies, I avoid ugly companies altogether. And in this, if some bad companies may also come, I know that I may get wrong, but I don't want to be destroyed by that. So because of that, there's huge diversification in my stocks. And that takes care of my errors also. I may be wrong in my errors, but that won't kill me. I may be wrong in 5% of the stocks or 5 or 10% of the stocks that I'm holding, but that won't kill me. So diversification is a really good tool to take care of these issues. And diversification also has, maybe I'll answer that in another question. I think this has answered. You should look at the
yeah, thank you, Geordie. Arun, do you want to add anything more into that?
Yeah.
Regarding the delisting activities currently that is happening?
Exactly. Actually, my first question to every investor in this market is, why you are investing? You are investing you are investing for a specific purpose. So before that, you should start thinking in this way that, yes, I am going to be a business partner of this company, or I am going to give hands with this management. Once you start thinking this way, you can definitely avoid at least 90% of all this kind of issues. One simple example, let me pull it down at this moment. This Vedanta issue, if anybody who has invested in Vedanta, had they ever gone through the management history of Vedanta, who is a promoter, what is their previous history, what they have done before, then definitely I'm sure he will never buy Vedanta. One simple example, Sterlite Industries. Sterlite Industries was also owned by the same promoters. They did the same thing with Sterlite also. So those who know that will definitely never go with this. And we cannot do much things on this game because it's their right. They are the major promoters and they have decided to do this. They will definitely do it. And that's one thing. So once you start thinking in such a way that, yes, I am going to give hands with this promoters, I am going to be a part of this business, I am going to be a part of the growth of this company, then definitely the view, the angle, the way you think as an investor will change definitely. So for example, if you have 100,000 rupees, if you are a person who is sticking on to ethics, I'm sure you will definitely go with Tata Group. Reason being, you are ready to wait, but you trust the group, you trust the ethics, you trust the management, you trust the ethics, policies, principles, everything. So definitely you will go for that. So if you are into these long-term gains, definitely I would suggest strongly should go with a good management and always try to track what was their past. From the past, we can know at least how they are going to tackle the future, or at least going to handle the future.
Yeah, but having said that, we all have been talking about Reliance and what is happening with the stocks of Reliance and how it is driving the Nifty 50. And they've announced that Geo might be listed in the next a couple of years. Won't it actually take out the entire value of Reliance, what is currently trading?
Let me ask you one thing. The Reliance has invested in Geo. Reliance Industries has invested in Geo. Okay. They now Geo is take 24.7% precisely. They have sold to major PE holders or private equity funds across the globe. All right. Still, they are left out with a 76.3%. Okay. So when what they have done with this sold what stock, sorry, they have sold their stake and they have got money. The same money has been used to clear the debt of Reliance Industries. So that has changed the picture of Reliance Industries. You should start thinking in that way, not that it is going to, and one more thing, the way in which the things are developing, I am 101% sure Geo is not going to be listed in India. Geo is targeting Nasdaq. Why Nasdaq? It's a technological driven company. Nasdaq is exclusively for technological driven company. So if it is a Reliance cannot go and list in Nasdaq. Definitely they cannot. So they are planned in such a way that this is going to be listed in Nasdaq, and definitely they will do it. And they may do some acquisitions in US also in order to grab the crowd, or let they also understand that. See, and the fundamentals of the company are very strong. This company, those who have invested, these private equity players have invested in these companies because they have got that much of confidence in the economy, the people, the business environment in India. So we may think that yes, what is going to happen? We are in an uncertain world. What is going to be next? Whether we are going to have a next crash? See how nicely they have sold off their stock, their stake. That too in these difficult times. At this point of time, raising equity or raising a fund itself is a big thing. And in that time, they have sold off 24.7%. That shows the caliber of that management, I would say.
Okay, yeah, thank you, Arun. There are a couple of questions more. A few are asking what's the look ahead for mid caps for the next 5 to 7 years. Geordie, want to take it up?
Sure. So when I look at mid caps or small caps or nano caps or large caps or mega caps, you know, I always look at the opportunity size. So why should somebody want to invest in mid cap? Because they expect that the business has got a higher scope of or has got higher growth potential. That's the reason. But it all depends upon the scope of opportunity. Like I was discussing about Reliance. Last year, I tweeted about Reliance that I think I tweeted that it's going to be 10x in 10 years. And that market cap at that point of time also, now also it's a huge market. But what I believe is that for a 100 crore company, or so for a 1,000 crore company, if the entire market size is say 2,000 crore, then they don't have any scope to grow. So I think one should avoid looking at investing in those companies based on market cap. Of course, there should be sufficient liquidity for a person to come out, or it should not be, yes, say, maybe 50 crore, 100 crore. I mean, it depends. But if we invest in those companies which have got reasonable liquidity, then you can sell it without going into uses and such kind of surprises. So that's why I believe it's the scope of opportunity. If clients due to Geo, due to retail, and last year, when they were doing all those things, and it was very clear that these people are not giving these discounts in Geo just to satisfy. They got much bigger dreams, and that were very much visible. So always look at the scope of opportunity, not the market cap. If we feel that 10 lakh crore clients is going to have a market potential of 1,000 lakh, say 100 lakh crores at some point of time, why not invest in that? If you think that a 100 crore company is going to may not grow more than 5 times in 10 years, then just simply avoid that. So keeping that perspective is very much important.
Yeah. Okay. Thank you, Geordie. There was a question to Arun also regarding gold funds. Do you know any mutual funds in the ELSS category for gold? Any gold?
Yeah, there is one called Nippon India Gold ETF Bs. It's a ETF Bs only. Hardly it is trading at 42 rupees. So I said we can even start off investing in gold with the 42 rupees. That's one thing.
Okay.
But still, I strongly suggest you should go with the sovereign gold bond, proven, assured. It is being offered by Reserve Bank of India. You cannot get a person more than Reserve Bank of India as a guarantor for your investment, I would say. And one more thing I'm telling you, at this price, you can buy gold. As Geordie has explained sometime before, the way in which gold is going to price, the increase in price because of the fundamentals, it's going to be drastic. It is really going to be drastic. Now we can buy. Tomorrow we can only dream of it. Day after tomorrow, we can only save what we have from somebody taking away what we have. That's my call on gold.
Okay, and one more question to you, Arun. What is your take on debt mutual funds? Is it a good time to go for it, or you should fully exit and stay out of it currently?
You can invest. I won't say that debt mutual funds are bad because of one Franklin Templeton or any other issue which has raised or surfaced recently. But you should know where these debt funds are investing. See, what happened to Franklin Templeton is that they have invested in AA rated or even less than that funds, which resulted in the whole series of issues. And they have invested in ILFS. They have invested in some other trouble-made companies. So you should know before where this company mutual funds are investing. You can just take their website. You can just go to their fact sheet. You can just go through their portfolio. You can use Money Control. You can use their own website. You can use visit the nearest shop. You can ask your broker. Anyhow, you can get all this information. So definitely you can invest. And one more thing I would like to add at this point of time is that there is something called as NPS, National Pension Scheme. In that, gold government bonds are there. In the last 1 year, government bonds, especially which is being managed by LIC, has given 18% returns. It's also a debt kind of an instrument only. So we cannot say that 18% delivered in 1 year of time, that to this scenario is bad. It's good only. So I will not say it is bad. You should have that in your portfolio. See, something like NPS, it has two benefits. One is for your retirement life as well as for your tax saving purpose. So you should have it.
Okay, thank you, Arun. To Geordie, one question. Typically, when you look at technicals or when you look at markets before investing, what is the time frame that you look in the chart? What would be a good time frame to analyze the stock? Whether it's 3 months, 1 year, 5 year, or how do you normally do
So
that?
my first filter will be based on fundamentals. Okay, so I know those companies are kind of good and great. I basically have only three divisions: good, great, and ugly. So good and great companies I look at. And in that I first I look at the monthly time frame, also the long term time frame. So I don't think one should fight against the trend. So if the monthly in the monthly time frame, say for years, this company has been doing very well, then okay, I know that okay, this company is okay. The market has approved that. Then I look into the weekly frame. In the weekly frame, also, if the company is having kind of a good trend up, then I buy there. Then I go down, come down from monthly time frame to weekly time frame to daily time frame, and yeah, and that's it. I generally go below that because that's pure buy and sell. My mind is not as fast, so to take such kind of quick decision. So I come down from monthly to weekly to daily, and I don't have any particular rule as such and that one should look. But I have only one rule, that is never go against long-term trend. So if the long-term trend is down, and then if I'm buying it based on some micro, some maybe on 1 hour chart or on 15-minute chart, then then I will have losses almost sure. So that's how I play. Yeah.
Okay, thanks. I think we are almost running out of time. One question maybe Arun can answer. Is it better to buy an RIL share in India or RILPP for a long-term investment point of view? Is there any difference at all on what's your take?
Yeah, definitely there is a difference. Definitely there is a difference. But I will tell you that you should wait and watch the show rather than entering at this point of time. Yes, I am sure that the Reliance will gain a little more also. But downside, there is so much of space still left over to correct itself. So see, all these are news driven. The news has come that this 24.7% stake has been sold off. Yes, but now the stock has moved up very drastically. It should correct a little, and after the next correction, which we are expecting very anytime soon, definitely it will come. Many people say that the corrections are already over, but my view and my call is that markets are about to see one more correction, which will be very deep in nature, and that should be the opportunity to buy Reliance. Yes, see the price difference between both. When it was listed, it was at something around 675. Now she is at 875, or if I'm not wrong. So actually, it is almost running in parallel, or even at 50% percentage lesser than the original RIL share. You can definitely buy it. Its impact will be more or less the same only, but still, I would suggest you should go with the Reliance proper share rather than going for the TP.
Okay, thank you. This one more question on NPS. Is there any limit on the amount of money one can invest in NPS in a year? I think the answer is no, that there's no upper limit. But for tax savings, you can claim up to 2 lakh if you don't have any other investments. But on top of 1.5 lakh of your ATC investments, you can gain up to 50,000 more. As per if you're going based on the previous tax regime. If you are in the new tax regime, you can't make any deductions of it, but you can still keep on investing in NPS, and there is no upper limit as far as I know. Arun, do you have any
No, you are very correct. You are very correct.
Okay.
And one more thing, there is a small loophole. If you go and invest 50,000, and if you are trying to say that I am going to claim this as ATCCD, no, ATCCD will be activated only after ATC gets filled up. Yeah.
Only after 1.5 lakhs is over.
Yeah, that's it.
Okay, and your views on PPF?
At this point of time, I would suggest that you should not go for that, because the reason being, the PPF rates are going to be reduced very drastically. We are going to have a all-time in the sense 46-year low rates PPF is going to register very time soon. So rather than going for PPF, I would say that NPS will be good for a long-term run. But go with rather than going with equity, you should go with some sector E. I mean to say this government bonds or something like that. You should avoid PPF, I would say, because already anyways you have EPF for sure, right? Employee Provident Fund will be there for any kind of a person who is in payroll. So after that, I would not suggest for another PPF. Rather than you can go for any other instrument.
Okay. Geordie, one question to you. How do you see pharma as a sector currently? Is it a pharma as a sector?
Really good. I mean, pharma hasn't performed well for say 6 or 7 or 8 years. I think pharma is going to have a very good journey ahead. Some of my shares are there in pharma also. Some of them are concentrated in pharma. I think, and as long as the journey is there, and you have a trailing stock of, let's say, 10% from the top, it's okay. I think pharma gives me that smooth way out. So because of that, I like pharma.
But the current price points, is it advisable?
Yeah, price point. That's what I told before. This valuation. Why is Tesla going up like anything? Or, why is Amazon going up like anything? I mean, Tesla is not having any profit. Amazon didn't have profits till the recent time. It's because people expect that there are going to be profits in the future. In terms of pharma, people don't have any other place to invest in it. I mean, because of this corona issues, pharma is one defensive sector where there's absolutely, maybe they'll take even advantage out of it. So I love those pharma companies and those medical device equipment makers like Polymedicure. I mean, anything related with pharma and medical devices and hospitals, those all are good for in these times, because that's where people can at least put their money with some sort of confidence, and at least they will be sure, they'll be assured that there won't be too much of earning shocks in pharma companies. So because of that reason, and they are not our value also. FMCG companies are kind of, they have been having a very long and I'm not saying that they will crash, but the accelerate the ascent of the price journey will be higher for pharma. That's what I mean.
Okay. And what's your take on any good instruments for parking for retirement savings? or Geordie or I don't want to take that up.
Yeah. First of all, you should be in a safer game as of this moment. So in that case, I have already said that gold you can invest 30% definitely you can invest. That to always go with sovereign gold bond, be perfect investment. Other than that, yes, you can go with some very good Nifty Bs. I can tell you, Nifty Bs is a very wonderful instrument which many people will not invest or many people are not aware of that. You don't even have to give a management fees if you are holding a Nifty Bs account. The only thing is you should have a demat account. Then you can definitely buy Nifty Bs. That's another opportunity. Number three, you can go with any large cap sector funds, among mutual funds. So that's a very good option. And definitely you can go with the NPS with our safe investments like gold bond, also government bonds. That's another option. So these all are my views for
Okay.
retirement and long term.
Okay. Thank you, Arun. There's a question. What is your beaten down levels for Nifty in the next crash for you, Arun?
I didn't get it. Can you just repeat once?
What is your beaten down levels for Nifty in the next crash?
6,700. The crash will start from near to 11,000. I'm not saying that from 11,000 the next week we can see 6,700. No, gradually, slowly, it will definitely reach to that level. 6,700 has to come, or maximum, or this arrow chances is that it may even come back to 7,000 series. Like last March 23rd, we have seen 7,511. From there or near to that, it may take a U-turn. But definitely, before seeing the sunset of 31st December 2020, I am expecting to see 7 series in Nifty.
Okay. So we'll have the last question here. What's your take on contract manufacturing companies similar to like that of Amber Dixon?
Okay, and I love both of them because contract manufacturing. We are looking at the theme of there is a mega trend that's going to happen, and that's Make in India. So and these contract manufacturing companies. So now the way that I think is, Red Bull. Red Bull is nothing but a marketing company. They own the brand, and everything else is managed by other companies. They outsource it. So Dixon is a company which is into manufacturing electronics, mobile phones, CCTVs, and such sort of things. Amber is a company which is a contract manufacturer mainly for air conditioners. And if I am an entrepreneur and if I want to build an AC company, an air conditioner, or say I want to build mobile phones, but I do not have the scale, the economics of scale to manufacture it at a small cost. So the logical decision for me will be that I will outsource the manufacturing operations to the best to companies like Dixon or Amber, who will manufacture it at a lower price and with higher quality because they already have certain quality standards. So that because of that, I think Dixon and Amber are going to do really well. They don't even have any serious competition. They are monopolies of their own. I am interested in Dixon and Amber as well. Both of them. This is a mega trend actually because we are lacking in manufacturing skills, and so those companies which are showing even slightly better manufacturing skills and the technology with them. So normally the business will go to them, and the market will go to them. And there will be huge demand there, and the numbers are also really good. So both of them. And Amber, I guess, its price is down because of this corona, but that's temporary. I love both of them.
Okay, thank you, Geordie. I think it's time to wind up. We had a good 1.5 hour session from 7 p.m. today. Thank you, alumni IIMK Kochi chapter, for organizing such a good event. I think it was very useful for those who have been part of this session, and very good questions that came in. And we look out for similar sessions happening once in every month in the finance series itself. And we could see more interesting sessions coming up. I invite all the team from IIM who have been listening to subscribe to our alumni IIMKAA Kochi alumni channel. The links and the comments are shared in the description of this particular video. And if you are particularly interested, there are programs coming up in this weekend. We have a session tomorrow at 4 p.m. And it's a very powerful webinar on improving LGBT inclusion in India and in the Indian campuses. And on Sunday at 2 p.m., we have a session on how to build a career in sales and marketing. And on Sunday 7 p.m., we have a chat with our own professor, Professor Atul Parvatia, as a part of the Sampashanam event. Lots of events are coming up. So please stay posted, subscribe to the channel, and we hope to see good sessions from you. Thanks again, Arun and Geordie, for your inputs. And disclaimer once again, these are their pure individual views, not to be taken as any clues for buy or sell or to stay invested. This is purely for educational purposes and for your own knowledge. Thank you all once again.
Thank you so much.
Thank you. Thank you, Deepak, and thank you everyone for watching.
Thank you.
Thank you.
Thank you, Geordie, also.
Thank you.
Thank you.
Thanks.